Great, good morning everyone. On behalf of S&P Global Ratings and our partners, PwC Bermuda, I want to welcome you all to our 12th annual Bermuda Reinsurance Conference. I'm Ben Bubeck. I head up the North America Financial Services Ratings Department at S&P Global, which of course includes our reinsurance ratings team, which is part of our broader insurance group, our banks, non-bank financials, and funds ratings teams. In total, our group of over 100 analysts covers close to 600 of the largest financial institutions in our region. I'm really excited to be again part of this premier industry event. I hope you share this excitement. We certainly anticipate an active and engaging dialogue and exchange of perspectives today. So it's certainly really been an action-packed year this year, particularly the past few months. But before I share my thoughts on this year's cat season, I would like to take a moment just to acknowledge those who have been and continue to be impacted by the recent series of cat events. I know that we all continue to offer our thoughts and prayers to those families who have been impacted by these unfortunate events. I also think that years like this provide us all a good reminder of the valuable service that insurers and reinsurers provide as we watch the coverage of the damage caused by these events and consider how important prompt and reliable resolution of claims is to your customers. That said, I would like to share a few thoughts on the analytical side as we conclude this year's cat season as well. First of all, from a ratings perspective, both the primary insurers and reinsurers we rate proved to be quite resilient this year. This year's cat events resulted in 0 rating changes so far and only 2 outlook revisions globally. Claim figures certainly were not as extreme as they initially appeared they could have been, but it looks like payouts could reach as much as $100 billion. For the reinsurance sector, this will be enough to wipe out earnings for the year and will end up being a capital event for some. However, overall robust capital balances provided sufficient cushion to weather this challenging cat season. We at S&P have certainly been pointing to the strength of capital adequacy as well as strong ERM as being a significant offset to the pricing pressures and stubbornly low interest rates that have been weighing on the operating performance of this sector for the past few years. However, I do want to spend a few minutes on ERM, as that is one area I feel there is room for improvement, particularly when it comes to the industry's response during times of stress. We at S&P were quite eager to get out to the market with our assessment of how the recent cat events may affect credit quality of our rated universe, and we did manage to comment within a few weeks of Maria's landfall. However, I was a bit surprised and perhaps a bit disappointed by the limited and delayed transparency that was provided by essentially all insurers and reinsurers following these events. You know, we certainly all understand that it's hard to pinpoint precisely the extent of damage to insured property. However, a ranged estimate earlier on would have been quite helpful and, in my view, perhaps a bit more aligned with the very high opinion of ERM that we have conveyed from most operators in this sector. I will also add that we've heard similar perspective from the investors we engage with, who are making buy and sell decisions within days or even hours of these events occurring. So I guess my key message is, going forward, we'll be looking for more prompt transparency. Without it, we'll be left to make our own and potentially conservative assumptions in order to provide a prompt opinion to the market. So, on the heels of a really active cat season, I think there are 2 questions that I expect we'll discuss quite a bit during today's conference. First, were this year's events enough to meaningfully reverse the slow but steady price decline this sector has faced in recent years? Our base case is that there will be a modest 0 to 5% increase in global reinsurance pricing next year, and I've read that others may be a bit more optimistic. And second, how will alternative capital react? Will there be a pullback that allows supply and demand to align a bit better, or will investors shrug off these losses after having achieved a sustained period of decent returns? And maybe one last topic I'll briefly touch on is regulation. It's been more than a year since the EU granted full Solvency II equivalence to Bermuda, and the BMA's regulatory regime continues to evolve. While we don't necessarily expect Bermuda to replicate the European framework, there are aspects of how the BMA develops It's group supervision that could have implications for how we assess capital adequacy and rate certain types of securities. We published a very detailed report late last week diving into this topic, which I encourage you all to read, and it's in the back to pick up. I'm also hopeful that our keynote speaker, Jeremy Cox, from the BMA, will share some perspective on this topic. And so with that, it is my pleasure to introduce Arthur Wightman from PwC Bermuda to share some of his thoughts and to more formally introduce our keynote speaker. Thank you, and I hope you enjoy the conference.
Well, good morning, everybody, and thank you, Ben, for your kind introduction. Let me take this opportunity to thank our friends at S&P for co-creating this, our 12th event now, and what I believe certainly promises to be an interesting day. Very unlike Rugby Week, when you wake up on a beautiful morning, as it is today, we are very removed from the destruction that nature can create. And as Ben highlights, though, when you think about the humanitarian horrors that ensued from recent events, you're immediately drawn to feelings of deep concern and a desire to help. And I think it is once again very important, as Ben did, to reflect on the societal importance of what it is that we do here in Bermuda and how much of a positive impact the protections we offer have in restoring communities and indeed businesses post-event. Frankly, without this market, billions of dollars of cover would not be placed because it would be commercially out of reach for so many. And this market, again, has shown its resilience. Its capital and strength sent a message that this market will be there in times of difficulty. And so it's with that backdrop that I am excited about today's lineup. Thematically, disruption is a big part of what we'll discuss, whether that be technological, political, investments, talent, or some societal shifts. But sometimes I feel that we think about disruption and talk about it as if it's a dirty word. I like to think of it as an opportunity. And indeed, many reinsurers are purposefully disrupting themselves from within in order to succeed. The future is indeed bright if CEOs can grasp the dynamic opportunities ahead, and many are. It's quite unheard of to think of the venture capital funds that are being established by reinsurers today, if you look back 2-3 years, and yet the number is at least 20 and counting. These funds are being used for a variety of reasons, but they are funding the big bets that are needed to be placed in order to seize a different future. We will hear a lot about technology today, and again, often seen as a disruptor, but of course a good one. Anything that can create efficiency through the overall value chain is a good thing. And we will also hear about the expansion of the overall market, how companies are connecting risk to new products where no insurance is currently available. We have a fantastic lineup of speakers, and I'm not going to get in the way of that for much longer, so I won't. But let me just cover one final point. The last few days have clearly been unsettling. Whether it is political pressure or tax reform, a focus on transparency, or indeed regulatory alignment, there are many challenges that have the potential to disrupt this market. That said, if you're standing here today, having done the groundwork, having proven the value proposition of a globally efficient reinsurance market, or led the way in establishing transparent mechanisms to share information intergovernmentally, or led the way in seeking equivalence at a global level against regulatory standards, then there is a basis to push back on some of the challenging pressures that this market faces. And therefore it leaves me to provide a very warm introduction to the individual who led Bermuda to establish its regulatory pillar for insurance and be equivalent with the highest global standards. Jeremy Cox is the Chief Executive Officer of the Bermuda Monetary Authority and has responsibility for all supervisory activities, including the supervision of banks, trust companies, investment business, and of course, insurance companies. The market owes this man a huge debt of gratitude, and of course to his team who stood right behind him, and we're obviously therefore delighted to welcome him as our keynote speaker, Jeremy Cox.
Arthur, you brought a tear to my eye. Now I've got to live up to what Arthur just said. So I don't know whether he set me up or gave me a wonderful introduction, but thank you very much. Good morning, everyone. And thank you for that kind introduction and your applause. It's nice to be amongst friends. I see a few people out there in the industry that I still do know. Thanks also to Standard & Poor's and PwC for this opportunity to address their 2017 Reinsurance Conference. My goal this morning is to attempt to take you inside my world, to give you a context for what we do at the Bermuda Monetary Authority, and hopefully an understanding of why we do it. I'd also like to try something a bit different today. In return for the insights I'm going to give you, I'd like to hear your thoughts about us, but I'll say more about that in a minute. As a financial services regulator, the Bermuda Monetary Authority is all too familiar with the theme of this reinsurance conference. We deal with the dynamics of discipline, diversification, and disruption in one form or another just about every day. And certainly the events of the last 2 weeks are keeping everyone quite busy. We've been doing this for years. It's become a core skill set and very much a part of our DNA. In fact, the ability to understand these shifting dynamics and their often unpredictable impact on our role has determined our response to the changes that have taken place in Bermuda's risk industry. From the early days of captive insurance companies to the arrival of large commercial reinsurers, and more recently to ILS and alternative capital, we've refereed a game in which the goalposts were constantly being moved. In essence, the authority has had to provide a stable supervisory environment for what I come to regard as a fast-moving industry of sectors without borders. By that I mean an industry characterized by a rapid rate of innovation amongst companies that are competing in a world of converging activities and disciplines that are increasingly blurring the demarcation lines between what were once traditional and distinct boundaries. The rate of change in the old model of company formation, registration, licensing, and capitalization, which were reasonably straightforward processes, began to accelerate in 2005. That was the year of Hurricanes Katrina, Rita, and Wilma, the year that the first sidecars were introduced. I think you all will remember those. In the ensuing 12 years, our function has become progressively more complex, the task more challenging. Today, goalposts are now considered a luxury, one that I can honestly say we've had to learn to live without. Now the focus is on understanding the elegant but often obtuse definitions of what we actually constitute a goal. But that's the job, right? That's what you expect of us, what we get paid to do. Or is it? Is there something we're not doing, or perhaps something you want us to stop doing? What I'd like you to think about today is whether the Bermuda Monetary Authority is doing the job that you, as an industry, need it to do. Does the authority help or hinder? Are we friend or foe? And friend or foe to whom? The companies who provide risk transfer solutions or the entities that buy them? Let me dwell on that for a moment. Our mission statement is unequivocal. As our annual report proclaims every year, we aim to protect and enhance Bermuda's reputation and position as a leading international financial center. Really? Is that what we should be doing? With so much attention and budget devoted to the marketing of our financial services sector, some might say that the job of enhancing the jurisdiction's reputation and position should not be within the remit of the regulator, but firmly and more appropriately in the hands of the business development professionals and the Bermuda government. Indeed, some might say that our mission statement should clearly reflect the explicit focus on policyholder protection. But let's just park that for a moment. Now, before we go any further, I should warn you that while I'm seriously interested in finding out what you think the regulator should be doing, it's worth remembering that there are some things, surprisingly enough, that we are not particularly good at. Yeah, that's true. After all, the historical track record of regulatory interventions that are supposed to benefit society at large is not exactly brimming with shining success stories. Take, for example, the case of the Hanoi rat plague in the early 1900s. Now, I know you're probably wondering, why on earth is Jeremy talking about Hanoi's rat problem around the turn of the century? But the truth is that this is an example of a regulatory control challenge given in a paper intriguingly entitled Tales of the Unintended: Well-Meant Regulations versus What Actually Happens. According to the paper put out by Thomson Reuters, rats had overrun the city of Hanoi in 1903 to such an extent that the authorities there decided to intervene by offering, and listen to this, citizens a reward for catching each dead rat handed in. Unintended result, citizens set up rat farms to increase their earnings. Another example in the paper is this 1920s prohibition of alcohol in the US and the modern war on drugs. The regulatory intervention was quite simply intended to ban the supply of alcohol and drugs. Unintended result, massive increases in organized crime. Unintended consequences also manifested when health regulators intervened to reduce patients' waiting times and cut delays in getting appointments with doctors. Result, medical practitioners simply reduced the number of appointments they booked. The truth is that regulators often tend to automatically assume that their interventions will be viewed as well-intentioned, generally in the public interest, and therefore worthy of support. But the reality is, as we all know, sometimes quite different. Support may not be forthcoming at all and may not come from the right stakeholders. Fortunately for us, and indeed for Bermuda as a whole, the authorities' consultative culture and constructive working relationships are such that in the main, we're able to work out most of the differences that arise. And I just want to make a quick, have a little byline, because just before this, it was commented to me that there were some meetings recently with the BMA, and some of the issues that people are having, as highlighted by the speakers just earlier, are trying to understand where we are going. And I think it's through that type of dialogue that that clarity starts to take shape. So what does this mean in practice? What does it mean is that we exist primarily. We certainly don't exist primarily to rubber stamp, generally acquiesce, and pretty much approve everything that lands on our desks. That's not the BMA. That certainly would not constitute good supervision. Which raises a key question. What exactly is good supervision? And who says that it's good? The International Monetary Fund offers some helpful guidance here. According to the IMF, good supervision is intrusive, skeptical, comprehensive, adaptive, and conclusive. The IMF paper, which was published under the title of Making Good Supervision, Learning to Say No, talks at length about the regulator's ability to act, and this is key, the will to act. Supervisors must have the ability in law and in practice to take action. They must have the authority to be intrusive and to challenge management's judgment in a proactive way. They need enabling legislation to fulfill their mandates, requiring the right people and the right tools, sufficient funds, and a high degree of operational independence. Striking a cautionary note, the IMF recommends that supervisors should be able to dialogue with industry, but it says that this relationship should be arm's length, and it warns against the risk of what it calls regulatory capture. Supervisors, and I'm quoting now, must be willing and empowered to take timely and effective action, to intrude on decision-making, to question common wisdom, and to take unpopular decisions. There's an article today that ties to the recent release of these papers, the Paradise Papers, they're called. And there's an article in the Times today that speaks to the Bermuda Monetary Authority's actions. And I think I'm not going to get into the details, but clearly from that piece, one can see that the Bermuda Monetary Authority was willing to take the action that was required. In reference to the collapse of the financial markets in 2008, the paper concludes the discourse must now move from influencing the incentives of industry behavior to understanding and addressing the incentives for supervisory behavior and understanding why the will and ability to act in some countries dissipated over this period of extreme exuberance. Supervisors, according to the IMF, perform an unpopular role. They're expected to stand out from the rest of society and not be affected by the collective myopia and consequent underestimation of risk associated with the good times. I asked you earlier to think about what you need from the BMA. As you ponder that, you should perhaps also give some thought to the kind of supervisory infrastructure that's required to support the desired culture. Do you, for example, want something along the lines of the UK system, in which responsibility for prudential regulation and supervision of banks, building societies, credit unions, insurers, investment firms is consolidated within the Bank of England? Or do you favor a more siloed, fragmented model, allowing separate national agencies to supervise separate elements of a country's financial services market? According to the Geneva Association, the respected European risk and insurance think tank, silos work best in a financial services industry in which clear demarcation exists between banking, securities markets, and insurance. However, as we saw during the financial crisis, a system of separate supervising entities can increase the risk of regulatory arbitrage. So what I'm saying is that the integration of financial markets, the steady convergence of sectors without borders that I referred to earlier, calls for more integration in supervision to reduce the risk of deficiencies in information flows. For the record, the BMA is an integrated regulator, and I should tell you that the BMA supervises, regulates, and inspects all financial services entities in Bermuda. It also issues Bermuda's national currency, manages exchange control transactions, assist other authorities with the detection and prevention of financial crime, and advises the Bermuda government on banking and other financial stability-related matters. More than a mouthful. The authority develops risk-based financial regulations that it applies to the supervision of banks, trust companies, investment businesses, investment funds, fund administrators, money service businesses, corporate service providers, and insurance companies. It also regulates the Bermuda Stock Exchange. While you're deliberating and digesting all this, you also may want to consider what kind of enforcement culture should be in place. Until fairly recently, publicity of an enforcement action taken against an offending entity was limited to a brief and anonymous mention in our annual report. That all changed the beginning of 2016 as we set out to demonstrate not only that we have the right legislation and rules in place and are willing and able to enforce them, but crucially, that we're prepared to be seen to be enforcing them. An important but controversial component of this new era of enforcement is complete public disclosure. That means we publish details of an enforcement action while also announcing the name of an offending company and/or individual. So I guess the IMF was spot on. Sometimes you must be willing to be unpopular. That's not to say we're always unpopular. On the plus side, successfully securing equivalence, as Arthur highlighted, and certainly obtaining agreement from the National Association of Insurance Commissioners gave Bermuda, certainly giving Bermuda qualified jurisdiction status, thereby reducing U.S. collateral requirements applied to reinsurers, were big wins for us, and a significant boost for our relations with overseas regulators. Not that we're here to win votes. We're here to police financial services and protect Bermuda's reputation. That's what the BMA is paid to do. But if you were to ask me to name the biggest single thing the authority could do to help the Bermuda industry, especially during the current period of recovery from a series of massive catastrophe losses, I would say that doing our job and executing it to a consistently high standard still ranks as the single most valuable contribution we as regulators can make. If you remember nothing else from my remarks today, please don't forget that. It's rather like the Bermuda reinsurance market's contribution to the global economy. Ultimately, your function as reinsurers is to pay the legitimate claims of your policyholders, thus keeping the world's economic engine ticking over. It's what you do. It's the mission-critical part that you're relied on to play. I should add here, in terms of the U.S., there's no clearer statement of this ability to provide emergency support to a financially stressed economy than that put out last week by the Florida Insurance Council, commenting on the aftermath of Hurricane Irma. The council said it expected that more than 40% of Irma homeowners' claims, valued at an estimated aggregate of $4.6 billion, will be paid by Bermuda's reinsurance market. ABIR, the Association of Bermuda Insurers and Reinsurers, said that shortly after the recent storms, Bermuda-based reinsurers began wiring hundreds of millions of dollars to primary insurance accounts impacted by the hurricanes to help sustain recovery in Texas, Florida, Puerto Rico, and the U.S. Virgin Islands. The Florida Insurance Council statement said that its use of reinsurance had, quote, globalized Florida's risk. It said this had helped to lower insurance prices and had effectively reduced the burden on the state's taxpayers. Somehow, we must continue to message that during these times where jurisdictions around the world are reassessing their tax policies. Reading the statements of the Council, it becomes clear that stable and transparent regulation is a major factor in the placement of catastrophe business. In my experience, it also often influences the choice of jurisdiction by a new company or group of investors. But there's another key determinant that I haven't mentioned yet, and that is speed, or more accurately, speed to market. Just how quickly an investor can secure a license, deploy capital, and commence underwriting, typically at a not-to-be-missed crucial stage in the market cycle, will often prove to be a decisive business factor. If the moment's missed, the proposed underwriting entity may decide not to move forward with risk assumption. Timing can be that critical and that sensitive sometimes. In Bermuda's case, this is often where we can demonstrate a clear competitive advantage over other jurisdictions. So what's the next big thing in regulation? Right now, we're looking at technology and how it helps us to execute our strategy. Still early days, and we're not yet clear where this all will lead, but we're actually examining the potential use of artificial intelligence in helping us to become a more proactive and forward-looking supervisor. And I see some of my insurance supervisory team over to my left, and these are the guys that are really spearheading these moves and certainly are going to be the key supervisors of the future at the Bermuda Monetary Authority. We see this as promising technology, so we've begun to explore how or whether we can exploit it and hopefully transform supervision and how we spend our time. Not so long ago, supervisors spent an enormous amount of time calculating ratios and other metrics to be able to benchmark companies and perform risk assessments. Much of this work is now automated. Rather than calculating ratios, supervisors are able to focus on interpreting these metrics, which is a much more value-added prospect. This has freed up supervisory resources to spend more time on the front line, hosting supervisory colleges, which is a critical thing if we are to continue to enhance our credibility in terms of Solvency II equivalence, conducting meetings with peer regulators around the world, and service providers such as the auditors and the rating agencies, as opposed to long hours in the back office. But we're not completely out of the back office yet. A key task for any regulator is to be able to understand risk. But in some cases, risk can be hidden in qualitative data where it can manifest before showing in the numbers. So supervisors still need to manually analyze the qualitative information. This is time-consuming given certainly the large amount of data that we now collect from the firms. Like the industry we regulate, the BMA prides itself on being innovative. Using technology, we aim to be better able to detect issues as they're beginning to develop so that appropriate supervisory measures can be taken before major problems arise. I guess we're back to the importance of timing again, and I think my time is now up. Ladies and gentlemen, don't forget to let me have your thoughts, comments, and warts and all observations on what you want or need and don't want from the Bermuda Monetary Authority. My email is jcox@bma.bm. Thank you.